Hi, welcome to our video series here with Burkholder Wealth Management. I'm Jordan Bradford and I'm here today with Eric Burkholder. And our discussion topic of today is going to be SVB, Silicon Valley Bank, and what's going on in the regional banking world, which I'm sure you've heard some news already about this. But we thought we'd just provide a little bit of analysis on what's going on and what that might mean for potential investors all around the country, not necessarily investors in SVB, but just how is this affecting your portfolio or your retirement plan? So we've got some thoughts, some different things we want to cover, but obviously this is still a fluid situation too. So hopefully you'll get to watching this video shortly after we filmed this here.
Yeah, and probably just for maybe there's some people out there that have not heard. It's unlikely, but we probably should touch base just to give you a high level overview of what's going on. And so Silicon Valley Bank went under, was taken over by the Fed, however you want to describe it. So the largest bank failure since 2008. And so raised some red flags, definitely spooked the market. And then subsequently, we've had another bank, Signature Bank, also went under, and we've had, First Republic.
Yeah, so there's been some other
Signature
banks.
Bank has just got rescued by not the federal government, but 11 other larger banks came in and infused them with some cash. So there are some banking issues. People are clearly concerned about contagion and what does that mean for the overall market. As Jordan said, this is a still evolving situation, but it does seem there are some very specific issues with these banks. This is not a 2008 type scenario where virtually every bank in the U.S. had exposure to some of the real estate problems and collateralized debt obligations, things like that. These banks specialize in very specific clients. And Jordan, you want to tell us a little bit about that?
Yeah, so Silicon Valley Bank, I'll use them as the primary example because they kind of started this whole mess that we're finding ourselves in. But so their primary client base, their customer base, is not your neighbor, right? Unless your neighbor is a very, very wealthy venture capitalist. Most of their customers had very large deposits. We're talking well over the FDIC insured limit of $250,000, which we'll get to kind of what that means as well. But many of these customers had well over $1 million in single account deposits. Typically, they're like accredited investor type folks. This just isn't your normal banking situation where you've got mom and pop going there to deposit their payroll check or to just take money in and out of their checking accounts just for regular purchases. This is a bit of a unique banking customer base, very specific to investors who are investing in large, startup firms. They're very capital intensive, and they were using SVB as a conduit for lending, which also then created the problem of them needing to have so much money on deposit to incentivize the bank, SVB, to actually go ahead and lend to these startup businesses, which normally are getting money through other avenues rather than just your traditional lending programs.
Right, and because of the run-up of tech and venture capital and a lot of money moving through those spaces up to 2022, there was some dramatic growth. SVB, I think, essentially in 1 year, and this will be a local example for a lot of people. In 1 year, they grew at like an additional Bank of Oklahoma, not just Bank of Oklahoma, but BOK Financial, which owns Bank of Texas, Bank of Arizona, Colorado Bank, and so in 1 year, they grew added an entire size of BOKF Financial.
So just naturally, they didn't. It wasn't from acquisition.
That's through deposits, and that's just wild. $100 billion in a year for a bank is massive growth.
And so what did they do? What did they have to do with all that money?
And so you either lend it out, which with that amount of growth, you really can't lend fast enough. Or you can buy assets, and typically banks can buy things like mortgages or treasuries, and so
traditionally safe investments,
safer investments that
banks buy.
Correct. in this case, they loaded up on long-term debt, long-term bonds, mostly U.S. Treasury obligations at the worst possible time
right.
in history.
Yeah. After we'd had a period of time where interest rates were hovering around 0% for nearly a decade, they decided to, put all their eggs in one basket, if you will, which, creates a big problem, right? As we know, when interest rates rises, bond prices fall inversely. And when you've just purchased tens and tens of billions worth of fixed income instruments that are long term and rates go up by 4 to 5% in a matter of about 12 months, big problems.
Yeah. Compound, and only a problem when you have to start selling those securities.
That's right.
And so you really have this domino effect of, obviously everyone's familiar with the slowdown in tech and venture capital. We've seen all the layoffs, mostly isolated to those sectors. And so when that industry started slowing down, the companies that were flush with cash, no longer flush with cash, and now they're having to use those deposits to cover operating expenses.
Yes.
And so if people start taking their money out of the bank, because I think most people know banks keep very little cash on hand, right? They use leverage. That's how they make money. And so as deposits go out, they start having to liquidate those investments at a massive loss.
Yeah, and so at the end of 2022, SVB had on their books roughly $17 billion worth of potential losses, which, as Eric mentioned, right, this was money that hadn't been lost officially yet, but presented a real significant challenge for any company, whether it's a bank or any other business, to have a potential $17 billion loss that's sitting on your books creates a lot of anxiety. And that's really kind of where the biggest problem started, was right at the end of the year, and then heading into 2023 here, because we had all these losses on the books, and then the economy started to slow down. There were some issues going on, and so withdrawal requests increased. And these are, as we mentioned, these are customers that had millions of dollars on deposit, not just, $20,000 in their savings account that they pulled out because they had an emergency that came up. But, they were pulling out millions and millions, and it actually got into the billions of withdrawal requests. And what really kind of sealed the deal was there was about $42 billion, that's a billion, in withdrawal requests in a matter of about 24 hours.
That's wild. And part of that, so the final nail in the coffin was the businesses and these VC CEOs and founders who were pulling their money were also calling up all their buddies saying, you need to get your money out.
Yeah.
I mean, it's an old-fashioned bank run.
Yeah, that's exactly what happened.
You wouldn't think into this day and age that can happen, but it can.
Yeah. When your customer base is so dependent on these large investors, and they all have substantial sums of money in the bank, it makes sense how it can easily spread, right? There's just that fear of, we might not be able to get access to our $10 million checking account. That's a problem.
Right.
So of course, right, there's panic within that particular community group of, VC investor type people. And that really created a lot of problems.
Yeah. And, to address the, concerns out there of contagion, things like that, because there have been a couple other banks. We mentioned First Republic and Signature Bank. I mean, it more or less is still the same issue. Both those banks, First Republic, also San Francisco based, mostly venture capital, Silicon Valley type money is who they worked with. And the Signature Bank, which is out in New York, but 25% of their client base had some connection to crypto. So again, as we know, major issues with that part of the market. And so while these banks aren't specifically tied to each other, their client bases were very similar. They had very concentrated assets and tied to industries that aren't doing well.
Right.
And so that seems to be the issue. Hopefully, the Fed has come in and said they're going to back all deposits, even over $250,000. We won't get into the moral hazard of that, but I think right now they want to make sure that people are feel comfortable with the banking system.
And there's pros and cons to doing that. And, as Eric said, we won't get into all the pros and cons of it, but it's not an easy decision, I don't think, for the Fed to come in and decide to insure deposits that 2 weeks ago were considered uninsured.
Right.
So there's a lot of potential fallout from that. But I think that as we look at what's going on across the board, I don't see anything specific that looks like it's going to spread to banks that don't have that type of exposure.
Right. And I think another thing that's useful to point out, obviously this is getting a lot of headlines. SVB, the second biggest bank failure since 2008, but bank failures actually happen fairly regularly, just since 2012. So I went back to 2012 because in 2010, 11, you still had a lot of fallout from 08. But over the last 10 years, we've had about 124 bank failures.
Wow.
Right? Most of these you never hear of. The Fed comes in on a Friday afternoon, takes over the bank, they reopen with a new name on Monday. And, the whole point is to keep people from panicking.
Yeah.
This is different because it's a larger bank, and most of that is because of, as we mentioned, how quickly they grew. But it's not unheard of. And so I think, just to reiterate your point, it doesn't seem to be a systematic, entire banking system problem. Certainly, as we've seen, anything like this uncertainty is going to cause some headaches in the market, some volatility. And there's definitely, I think when you look at, again, the tech space and venture capital, private equity, there's some major issues there.
Yeah.
That is the underlying issue. It's not so much the bank system, but it's that client base. And we've already seen a lot of pain there, and then kind of speaks again to just being diversified, right?
Right.
Because if you're 100% tech, that did really well for a while, and now it's really hurting. And so we're still seeing the fallout of that, and then hopefully, we can get through this like we've got through a lot of other market fluctuations and come out on the other side. But there's just no better thing than being diversified and not having overexposure to any one area because of something like this can happen.
And I think it also is a good time to revisit, just the idea of what it means to have cash in the bank. And, one, if you're under that $250,000 limit in your bank account, this isn't something you really need to be too concerned with, because you're insured up to $250,000.
Right.
But this is a good reminder that if you're sitting on very large sums of cash, it may be a good idea for you to think about, how do I reposition that to make sure that I have the adequate FDIC insurance? Because one thing I'm pretty confident of is that if this happened across the board, there probably wouldn't be the FDIC stepping in and covering everybody's deposits. The goal, I believe, that the FDIC is trying to accomplish here is to prevent the spread of this. Right. And part of that is to get ahead of it, attack this particular issue head on quickly to avoid that spread. But one thing you can do as an individual is to reduce that risk on yourself. If you're sitting on that much cash, well above that limit, one, maybe a good time to talk with your advisor about whether or not cash is the right asset class for you to hold. And two, how to properly diversify that even amongst institutions and different types of accounts to keep yourself protected from being overly exposed to an unnecessary risk. And that's what it comes down to is, if you're not required by your bank to hold those large deposits for some sort of loan that you have outstanding, there's no reason to be above those limits in really any scenario, because you can just diversify within different banks.
Yeah, great point. And for most people out there, outside of maybe business owners or ultra high net worth, you're not hitting that $250,000 limit, but there are a lot. It's pretty easy to get to make sure you're covered. To your point, even within the same bank, there's things like Cedars programs where they can spread your money around and make sure that your accounts fall under the 250. And so I think there's definitely ways that you can make sure you're protected, but I wouldn't worry. For 99% of people out there, you're fine. It's really not something be concerned about. But yeah, it's a good point of risk management is important.
Yeah. And I think it's also worth noting, this is a little change of the subject from personal risk management, but when a lot of people are seeing the news headlines, I think the initial assumption is another big bank bailout, another big company bailout, and that may be true to some degree, but I think something worth noting is that the senior leadership at these banks are not getting a pass. Right. In fact, it's been reported that the CEO of SVB 2 weeks prior to all of this happening sold just shy of $4 million of company stock. He's probably not going to get to keep that. I'm not trying to speculate too much, but typically the government doesn't like that. And so, these senior leaders at these banks, they're not getting a free pass in this situation. Right. They're in all likelihood, what happens at a lot of these big companies is they hold large concentrations of company stock, which is another, recommendation that we generally would give clients is try not to be overly concentrated in your own company that you work for. Yeah. Because something like this could happen. Even if you're just let's say you're a mid-level employee at SVB, you weren't involved in the decision making that led to these problems, but you also, maybe had saved up a good amount of money, were investing in your own company stock, and now you're looking at your retirement portfolio and it does not look good. Right. So it's just a reminder of, if your employment is totally tied to your company, you don't necessarily want your retirement to also be totally tied to that company. It's a lot of risk you're taking. And, I think that there's strong arguments to be made that you're not going to get the return that correlates with that amount of risk. It's just very unlikely. Right. But these senior leaders, right, they're not going to just be able to walk away from this and just, have everything go great for them going forward. They're going to be in a lot of financial trouble as well. And I think that they're going to be looking long and hard at sales of company stock in the, I would say probably going back 12 months. I bet they'll look back in the previous year and look at leadership executives that sold large portions of company stock in any of these banks that are struggling. Because that's typically a sign of potential insider trading violations, which is a big deal.
Yeah, they're not getting a free ride. That's important to point out. The federal government is backing customer deposits. Mm-hmm. We could debate, maybe there's some moral hazard there, but certainly the leadership, the owners of the bank are not, getting their money back. Right. They're losing their jobs. They are most likely, like you said, gonna face some lawsuits, and these banks are essentially bankrupt. Mm-hmm. The client's money has been backed up, but the investors are not going to come out on the other side of this.
Yeah, and so I think maybe going on to like what's next, right? We obviously don't know. We don't know, and we don't want to get in the business of predicting whether or not another bank is going to be falling under this particular issue, right? Because there are probably other banks out there that were lending and had customer bases that were similar. Mm-hmm. So we could see potentially more of these. We don't know. But if we assume that this doesn't, lead to any other banks having troubles like this or failing potentially outside of that very small group of, your VC investor banks, I think the big question that comes to mind is this going to have an impact on the Fed's decision to raise rates or raise rates as quickly as they have been? Because I think a lot of folks are probably looking at the Fed's decision to raise rates so quickly in the last 12 months as maybe that is, at least in part, some of the issue that happened. So sure. I think that's a big question that we have going forward now.
Yeah, and I would say it's very difficult to predict what will happen. And it just goes back to well-structured portfolios, good investment strategies are based on long-term principles and really need to be designed around we don't know what's going to happen.
Right.
We've seen how quickly things can change. That's always been the case. And so create a portfolio and investment strategy that can withstand all this uncertainty. Because trying to invest on the idea that I can predict what's going to happen is certainly a recipe for a disaster.
Yeah, well, that's kind of what the market does, right? The market's trying to predict what's going to happen, and that's why we're seeing in the last week swings of 1.5% positive, 1.5% negative, because the market is trying to analyze that. But as investors ourselves, we shouldn't be doing that, because we're not going to be able to get that data faster than the market, and we're not going to be able to implement it into a portfolio quicker than the market can adjust for price.
Right.
So I think diversification, great way to insulate yourself from some of the volatility. Not all of it. You want to have some volatility in your portfolio, because if you have no volatility, you probably don't have much of a return either.
Right.
So you want to take a little bit of that, but I think the point is we want to be invested across a lot of different asset classes, because if one asset class is overly exposed to this particular sensitivity in the market, we hopefully have other asset classes that don't have correlation that matches with that. And that's where we can see some positive returns in certain areas of the portfolio, which is important across the board, but especially in retirement. If you're taking distributions, you don't want to be pulling money from a fund or a set of funds that are all correlated with the same systemic problems. And unfortunately, I think, we probably agree on this pretty heavily. We see a lot of that with outside portfolios. Yeah. When a client comes to us and they have a portfolio elsewhere, a lot of times it's heavily concentrated, whether that's just U.S. stock. Sometimes it's just large U.S. stocks. Mm-hmm. And I would say if you only owned large growth right now, I'd be a little nervous about that particular asset class, significantly underperforming due to the systemic risk of, we have high inflation, potential recession, interest rates rising, and you're seeing that happening within these small, well, I shouldn't say small, pretty good sized regional banks.
Right.
But we're seeing that happening there. So I think having your asset classes diversified really, really is important, especially right now. And I think it's always important, but
yeah, we see why
mm-hmm.
it's always important in times like today.
Yeah, it's much easier to identify why it's important when things aren't going as well as what we'd hope.
Right.
The old adage is a rising tide raises all boats, right? Yeah. And I think we saw that leading up into 2020. The 10 years prior to that, it just seemed like every year, like clockwork, the market was just going to go up, because we didn't really have much of volatility in that 10-year time frame. And I think that a lot of investors, professional and amateur investors, got a little lazy and stopped diversifying across asset classes. And we saw the impact of that in 2022. You've watched our market videos on that. And we're seeing it right now at the beginning of 2023. So I think that maybe the silver lining in this is being diversified is really paying off now.
Yeah, absolutely. Well, we could talk about this forever. And it's like we said, it's still ongoing. So maybe we'll end up coming back and doing a video part 2. But if there's any other questions out there that you all have, feel free to contact us, reach out, shoot us an email, or give us a call, and we're happy to address any questions you have. But we want to assure you that we think your cash is safe. If you're investing with us, you're broadly diversified. We shouldn't be in a situation where the collapse of SVB Bank, destroys your retirement. Mm-hmm. If that's the case, planning was not done correctly. So, right. But yeah, happy to answer any questions. Let us know, and we'll see you guys on the next video.